Welcome to The Explainer. Today we're jumping into the super high-stakes world of financial trading to see how machine learning is basically rewriting all the rules. And our guide for this? It's this fantastic, really in-depth README I found on GitHub that lays everything out perfectly.
Okay, so let's get right into it. For forever, really, the whole point of active investing was to beat the market, right? But the game has totally changed. It's not about gut feelings anymore or just reading the morning paper. Now, it's about processing just insane amounts of data faster and smarter than literally everyone else on the planet.
So, the holy grail for any trader, the thing they are all chasing, is generating what's called alpha. Basically, it's about making returns that consistently crush the market average. It's the proof, the real proof, that your strategy is legit, that you've got a genuine, repeatable edge, and you're not just getting lucky.
And what this really boils down to is you have to be smarter and you have to be faster, period. You need better predictions than the next person, and you need the tech to act on them, like instantly. But here's the kicker. What happens when everyone gets smarter and faster? Well, the competition just gets absolutely fierce.
All right, so let's really dig into the problem here. Because the whole financial world has been turned upside down over the last few decades. And that's created this huge challenge for old-school investors. The classic ways of finding an advantage, they just don't work like they used to.
You can see this clear evolution, right? It's fascinating. We started in the 60s with, just simple electronic price feeds. By the 80s, things got way more complex with these quant strategies coming out of academia. Then, by the 2000s, everyone was doing it, which led to crazy stuff like the 2007 quant quake, where a bunch of funds using similar computer models all started losing a ton of money at the exact same time. And then, after the 2008 crisis, the whole board got flipped again. A tidal wave of cash just flooded into passive, super low-cost funds, which put the squeeze on active managers even more.
And with all this new competition, that famous 2 and 20 fee structure that hedge funds used to charge, 2% of assets and 20% of profits, it came under massive, massive pressure. Fund managers just couldn't get away with charging those high fees anymore unless they were delivering something truly special. It forced them to find new, more powerful ways to prove they were worth the cost.
And the result of all that pressure? This, a massive exodus. We're not talking small potatoes here. We're talking about $3.5 trillion shifting away from those actively managed funds and just pouring into passive ones. For the traditional funds, this was a catastrophe. Their money, their lifeblood, was literally walking right out the door.
Okay, so the old methods are failing. The pressure is on. The industry desperately needed a new weapon in this financial arms race. And that's where machine learning comes in. This wasn't just about making the old strategies a little faster. It was about inventing whole new ways to play the game.
First, let's just get our terms straight. Algorithmic trading. It's really just using computer programs to automatically follow a set of predefined rules for trading. It's been around for a while, but think of it as the foundation for everything that comes next.
But machine learning, now, this is where things get interesting. It takes it a giant leap further. These algorithms don't just blindly follow rules someone wrote. No, they learn patterns on their own, straight from the data, so they can make better and better predictions over time. They actually adapt.
And this right here is why it is such a game changer. Machine learning's real power is that it can find these tiny, hidden signals in massive, super complex datasets, things a human could never ever spot, especially with the rise of what's called alternative data. I mean, we're talking about wild stuff like analyzing satellite images of store parking lots to predict retail sales, or tracking credit card transactions in real time. It's about finding that edge in places nobody else is even looking.
And believe me, the industry has put its money where its mouth is. This isn't some tiny niche experiment anymore. Algorithmic approaches now control a huge piece of the pie. We're talking something like $1.5 trillion in assets.
And you can see the trend right here. It's just explosive. These algorithmic strategies, they've been growing at a clip of about 15% every single year. Meanwhile, a lot of the traditional funds have seen their money head for the exits. The writing's on the wall, you can't deny it.
So you might be wondering, how does this actually work? What's the process? Let's take a look at the playbook for building one of these modern, machine learning-driven trading strategies. It's way more rigorous and scientific than you might think.
Yeah, it's a super disciplined, almost scientific process. It all starts with the raw ingredient, which is data, and lots of it. Then you move into research, trying to find those predictive signals, what they call alpha factors. After that, it's about building a smart, balanced portfolio, and then, and this is probably the most important part, you test it.
You backtest it relentlessly on historical data to make absolutely sure your strategy is the real deal and not just some random lucky guess.
Right, so this isn't just a bunch of theory. Machine learning is being used in really specific and powerful ways across the entire investment process. I mean, from finding the first spark of an idea all the way to executing the final trade.
I mean, look at how versatile this is. Machine learning can do pretty much everything. It can dig through data to find the initial idea, it can help build out the final portfolio, and it can even use really advanced stuff like reinforcement learning to create trading agents that literally learn and get better on their own. It's pretty wild.
And all of this brings us to the final and maybe the most important point of all. The entire nature of investing is changing right before our eyes. The old lines in the sand are just being washed away.
So for the longest time, investing was split into two totally separate camps. You had the quants on one side, all data, all systematic models, all numbers. And then on the other side, you had the traditional, discretionary managers. They relied on deep dive research, gut instinct, and human judgment.
But those walls between the two camps, they're just crumbling. The future, what everyone's talking about, is quantamental. It's this hybrid approach that takes the best of both worlds. You've got the data science-driven insights from the quants, combined with the deep, fundamental analysis from the humans. It's a powerful combination.
And this leaves us with a really fascinating question to chew on. If machines can learn to beat the market, what happens to the human trader? What's their new role? And the thing is, the job isn't going away. It's just evolving into something completely different. Maybe the new role is about being the one who asks the right questions, who finds the best data, who oversees the very machines that are now out there playing the game. It's a whole new world, a brand new frontier.